Yo, yo. So I'm gonna start off. I got interrupted by a really important phone call. So my bad. But I'm gonna restart. I'm not restart. I'm gonna start from where I left off. We were talking about fractal. We were talking about how in nature and in shapes and stuff like that, there is a pattern within a pattern. So as you see this leaf right here, it's a full leaf, right? But inside this full leaf, there's miniature full leaves. And inside these miniature full leaves, there is even smaller full leaves. And they're all repeating the same pattern. So mute yourself, please. Thank you. So so that's what we're doing here with the charts. And that's why I've been breaking down shit on the 4 hour and then going down to the 1 hour and then going down to the 15 minute because they're all connected. Um So, like we were saying earlier on the 1 hour time frame, we had missed this buy because we had our entry in the middle of this candle. We see that price wicked into this candle, didn't wick us quite. We were like 5 points away from getting wicked in, like 10 points actually, like 10 points. We're 10 points away from the market actually hitting our buy order that we called out, and we would have benefited from this move. But now that price is high and overbought, we waited for a 15-minute break of structure in this whole uptrend that the market created from that 1 hour area that was called out. So right here we're breaking down higher high and higher low, higher high, higher low, higher high, higher low, higher high. This is our most recent higher low point. When your most recent higher low point gets broken, that is a break of structure. And it gets broken because you will see candle closes closing past the higher low point. That higher low point structure, that higher low point structure ends right here at this line, at this straight line I have right here. It ends right there. These candle closes break past that line. So it's the same thing as it breaking past this. So it breaks past it, confirms our break of structure, right? Confirms a break of structure on a 15-minute time frame. And when there's a break of structure on the 15-minute time frame, it gives the 1 hour time frame permission to pull back. So there's the 15-minute break. It came into this area. When it came into this area, this green box right here, this candle right here, when it came into that, I attempted to sell with my stop loss on the other side right here. I got stopped out by like 2 points. This is called a liquidity sweep. So I got stopped out by like 2 points. Where is my? I got stopped out by 2 points right here. That little black little hair you see right there. That little black hair stopped my order out, and the market started to show signs that we're gonna price lower on the 5 minute. So when I got stopped out, I was continuing to look at price action. I got stopped out right here, and then this black candle came and formed, and then I see this pullback. And then when I saw this pullback, I looked at this imbalance right here, and I'm just like, there's no way, based off of my experience, I told myself, there's no way that they're just going to leave this imbalance behind without correcting it. And we have imbalance right here too. There's no way that the market was going to continue to uptrend from this. And sure enough, it showed lower pricing. And when it pulled back one more time into this institutional candle, I sold it. And the only reason why I sold it, like I said before, was because we have this break of structure. If it wasn't for this break of structure down here, right here, I wouldn't have even been attempting any sells in this area. But since I saw that we had a break of structure, since I saw that we had a break of structure and I saw that I got tapped out, I continued to look at price action on the 5 minute, and then when I got a nice little pullback, I pulled it again. So when that happened, price started to come down. Right now, I'm up like 30 points, and where I have this alert, that's my take profit for the first trade because I took the trade twice. I did a twin trade. I risked 0.5% on both trades, so I'm risking a full amount of 1% of my account balance. And when when gold comes to this alert down here, I'm gonna close one trade. I'm gonna close one full position. All right, because I have two positions open, risking 0.5% each. And when I finally hit, if I finally hit the final TP, which is this area right here on the 1 hour, that block, when I finally hit this, I will be closing the second order. When we get into this area, we're going to be waiting to see if gold wants to give us buys from this area, and I wouldn't be surprised if it does. From this 1 hour area right here. So as you can see, everything is fractal, everything connects, everything is working together. Um, so I won't be surprised to see this big correction all up into this zone, and then we get something like this on a smaller time frame. And so we come down into the zone. Something like that. You know what I'm saying? And if it doesn't happen in the middle, it'll happen over here at the top, just like it did. Just like it did right here, where the price literally missed us because it just tapped it and rocketed. So I will be calling out a pending order right here because we're not going to miss it like this last time. We're not going to miss it like this first time that where it wicked right here and then it just took off. So we will have a pending order at this line. And what I plan on doing with this pending order is I'm only going to risk half of the candle. So my stop loss, my entry is going to be at the top of this black candle, this fat black 1 hour candle. And my stop loss is going to be half of it. So it's going to be like around here, like 40-point risk. Give me a second. It's fucking acting wonky. So top of the candle is our entry. And then half of the candle is our stop loss. So this is the full candle. Full candle is 87 pips. Half of the candle is 40 pips, basically, roughly, you know? So I'll have my entry at the top of that candle, my stop loss exactly at 40 pips. If we get stopped out, we get stopped out. At least we attempted it. And if we get stopped out and we still see this price action, we will be reattempting the buy once we get the pullback into the zone to price higher. So we're gonna try out the buy when it hits, and then we're also gonna try out the buy if we get stopped out and it gives us this price action. But I will not be entering it twice if it does this and it does this. You know what I'm saying? I won't be entering twice. I'll only be entering twice if the first one gets stopped out. If the first one doesn't get stopped out, I won't be entering twice if I see this. But if the first one doesn't get stopped out, the first order the pending order, then I will be, I mean, the first, man, fuck it. I don't even know what I said. But long story short, I'll only be attempting this if our original pending order gets stopped. Basically, that's basically what I was saying. All right. So look. So far, gold is doing its thing. It's respecting the 15-minute break of structure. And remember, when I said when there's a 15-minute break of structure, it gives the 1 hour time frame permission to pull back. So if this is a true 15-minute break that I identified, we will see this whole 1 hour pull back the whole way. If it's a true 15-minute break. If it's not a true 15-minute break, then it's just gonna stop me out at break even. My trade is already at break even. My trade is already risk free. I'm not risking anything on it. Even though I did say that I was risking 1% because I entered in twice. But since I'm already up 30 points, and it's already at a 1 to 2 risk to reward ratio, I'm break even on my trade. That's my rule. If I'm at a 1 to 2 risk to reward ratio, my stop loss is at break even so that if the market comes back and taps my stop loss, I'm not losing nothing but a couple dollars, like $2 or $4. You know what I'm saying? So make sure that when you're in trades, as soon as you hit that 1 to 2, as soon as you hit that 1 to 2, see exactly 1 to 2.5. As soon as you hit that 1 to 2, move this stop loss risk free. You know what I'm saying? So I'm risk free, baby. You know what I'm saying? That's the best feeling in the world, to be risk free, because you're no longer, your emotions aren't tied to the trade anymore. And I learned that in a book too. So um yeah, guys, that is the 15-minute break of structure phenomena that we learned in school. Hmm. Super clean, man. And whoever was paying attention to the chat, Sniper Boy was in the same exact fucking entry as me. If anything, he was a little bit higher, but it was like the same area, like right here, which is so fucking clean. But yeah, man, that's how you know smart money is king. Because I wasn't the only one who caught the same entry, bro. You know what I'm saying? So yeah, guys. Any questions you guys have before I end this Zoom call? I'm looking at the chat right now. What's good? Hey, which Daniel is this? Is this Daniel Miranda? Yo, yo, can you hear me, bro? Unmute yourself, brother.
My bad. Nah, it's a different Daniel, bro.
Oh, okay, okay. All
Yeah,
right.
nah, it's all good. It's because I have my kids and they be screaming and stuff. So
Nah,
that's why I was
that's
like, I gotta step back.
yeah, that's good, bro. That's good. That's good.
Nah, thank you, though.
Yeah, no problem, no problem. But shit, man. Um, I hope y'all learned a lot. This will be recorded. The first Zoom wasn't recorded because I forgot to record it by accident. But we didn't talk about much on that video because I recapped everything basically here. The only thing we missed on the first video was the losing trades that not the losing trades. Yeah, the losing trade. The one losing trade that we got into today, which was NZD. It didn't play out like we wanted to. And that's fine. You know, losing trades is part of the game. That's why we trade by risk to reward. So if you lose 3 times in a row, so this is why I love the risk to reward rule. All right. I like to get into setups that at least give me at least a risk to reward ratio of a 1 to 3. All right. So I'm gonna type that down. Let me see. Only get into trades that give you only get into trades that give you a risk to reward of at least 1 to 3. Why? Because if you lose 3 times in a row, it will only take you one trade to be back at break even, if that makes sense. If that doesn't make sense, unmute yourself and ask a question. Um, but because I'm gonna type it down. All right. I only get into trades that give me a risk to reward of at least 1 to 3. Does that mean I'm only choosing trades that only give me a risk to reward of 1 to 3? No, I'm not, because this gold trade is a risk to reward ratio of fuck. Give me a second. This is a risk to reward of a 1 to 11. All right. When you become more experienced, you're gonna be able to hold your trades longer. Okay. But for now, just look for trades that give you a risk to reward ratio of a 1 to 3. Where did I write that? NZD? Yep. No. Yeah. Only get into trades that give you a risk to reward ratio of at least 1 to 3. Because if you lose 3 trades in a row, it will only take you one winning 1 to 3 trade to be back at break even on your account balance. So to clarify, for those that don't understand risk to reward, I don't know, maybe there's at least one person, or maybe we all understand it. But basically, risk to reward is how much, let's just put it in terms of fruits. Um, you're risking 1 apple to gain back 3 apples. All right. You're only going to get into trades like that, where you're risking 1 apple to get back at least 3 apples. So if you lose 3 times in a row, you'll be down 3 apples. But the next trade you get into and it wins, you'll make back all your 3 apples that you lost, and you'll be back at the original spot where you were at when you first started. So let's say you lose 3 trades in a row. Damn, bro. I got clapped this week. Remember our minimum of 3 trades per week rule. Bam. First trade hit stop loss. Second trade hit stop loss. Third trade hit stop loss. You're done for the week. There's a book called Reminiscences of a Stock Operator by Jesse Livermore. And he says in his book, he says, only a fool. Listen to what he says. He said, and I'm not quoting it because I don't remember it word for word, but he basically says this. He says, only a fool looks for action in the market every single day. Now, repeat that to yourself because that's important. He says in his book, only a fool looks for action in the market every single day. And this is why the 3 trades per week rule that I told everybody to follow is very beneficial, because it'll keep you from losing your shirt. It'll keep you from losing your ass. It'll keep you from blowing your account, because you get clapped 3 times in a row and you're risking 0.5% each trade. The most your account is going to be down is 1.5%. That's only 1.5%. That's not even a lot. And you're done for the week. Next week comes, you lose, let's say you lose one, and let's say you lose 1 trade the next week and you won 2. Bam, you're already in profits, but you've lost more than you've won. How does that make sense? Because of risk to reward. One winning trade will make back all your losses if you lost 3 times in a row. The second winning trade will put you at above break even. And if you get a third winning trade, damn, you fucking killing it, dude. You're fucking killing it. Because on a big account, let's say you take the exam on my Forex funds or whatever prop firm you trade on, or whatever website interests you or tickles you or whatever. Let's say you got a $50,000 account, or the 10K account. You know what I'm saying? Let me do the 10K. Let's do the 10K, because a lot of people mostly just take the 10K account. So when you're trading with the 10K account, I'm gonna break this down quick and I'm gonna end the Zoom call. Let's say you do the 10K account balance. The 10K account, I think it costs like what, $200 or $150 to take the exam. When you have the 10K account balance, you don't have $10,000 to trade. You have 12% of the $10,000 to trade. So it's 10,000 times 12% is 1,200. So in reality, you don't have 10K to trade. You got $1,200 to trade. Now, if you risk 1% each,
Balls up.
Mute yourself, please. Mm. All right. So with the 10K balance, right? You don't have $10,000 to trade. You got $1,200 to trade because that is 12% of $10,000. If you risk 1% each trade, it will take you 12 trades to lose your account or lose your exam. But if you risk 0.5% each trade, it will take you 24 losing trades to lose your account. Now, which one sounds better? Which one sounds better for you? Which one sounds safer? The second one, right? Because you have a lot more trades. Now imagine staying disciplined and only trading 3 times a week. Imagine staying disciplined and only trading 3 trades per week. How long will it take you to finish these 24 trades? Do you really think if you take 3 trades per week, do you really think you're going to lose all of those 24 trades? Come on. I know you believe in yourself. You know damn well you're going to find some winners in there. So it's going to be nearly almost impossible for you to lose your funded account because of the fact that you have so much trades in your belt and you're only trading 3 times a week. In a full month, in a full month of trading, you should have only traded 9 trades in total. People who do not follow these rules will always blow their accounts. If you trade by percentage and you trade by risk to reward, all of this stuff adds money to your account by itself because the law of probabilities are in your favor. You become the casino and you're no longer the gambler. Does that make sense? Especially being a part of this chat, being a part of this legendary chat that constantly finds winning setups, it will be impossible, almost, I'm not going to say impossible because everything is possible, but I'm just saying it'll be very, very difficult for you to lose 24 trades in a row following the trades that are dropped in the chat or following the strategy that's been taught. You know what I'm saying? In 1 month, you should not have more than 9 or 10 trades. Risking 0.5% each, 9 trades in 1 month, you should at least be up 10 to 15% by the end of the month. And if you don't believe me, try it for yourself. You don't need to trade a lot to make money in these markets. Trading less is more. Trading quality setups will build your account faster than being a gunner and looking at and trading everything and anything you see just because it looks good. All right. So this is very, very valuable information, and this is recorded. This is recorded, and it will be uploaded to YouTube so that y'all can so that y'all can so that y'all can go back and review what was talked about today. Y'all have any questions before I end the Zoom? No? All right. Well, this will be recorded and uploaded onto YouTube. Like and subscribe to my channel. I know everybody on YouTube says that shit, but show some support, man. Like I really love it. I appreciate it with all my heart. Comment under it, put a smiley face. It don't matter, you know. put a shit emoji for all I care. It doesn't matter. Just show some support. But yeah, like and subscribe. I'm gonna upload it in a few, and I hope y'all learned a lot with this Zoom meeting. And stay blessed and enjoy the rest of your day. Peace.